would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. Today's Thursday, October 6th, 2016. It's another one of those. I should almost save this for Friday. We could have done another tinfoil hat Friday. Although there's not enough tinfoil on this one. This is coming from too many mainstream sources. So I guess we can't really go there. The stuff that would normally have us thinking it's a crazy thing to think is becoming pretty mainstream. So it's one of those times when you wish you weren't right when you figured something bad was coming. But we'll cover some of that news. If we have time, there's one more little thing we might cover. One of the articles we're going to talk about today is one of the article I mentioned yesterday that really jumped out at me that I wanted to include in yesterday's show, but we didn't have time for it. Fasten your seatbelts, I guess, is the best way to prepare you. If you'd like to reach out, you can do that via email at therebelbroker.com. And I know that there was two ats there. The first at is AT. The second at was one of the little, ampersand looking things. So just send me some email to therebel at therebelbroker.com if you'd like to send an email, or you can head over to the website, therebelbroker.com, and you can click on Contact the Rebel Broker, fill out the form, click Send. Please send any ideas, suggestions, observations, or questions that you might have. I'd be happy to respond. Also at the show, you can enter to win a $50 gift card to Amazon just by participating in a audience survey. Isn't that fantastic? And you're helping to grow the show, because that's specifically what that goofy survey is for. It's a red button, tippy top of the page at therebelbroker.com. Click that bad boy, enter in your email address and your name, click Take the Survey, use the same email address again in the actual survey, and as long as those two email addresses match, you'll be entered into the drawing. So we just had our first drawing on October 1st, and our good buddy Shannon, a fine gentleman, won the $50. So congrats to him. And you could be next. Isn't it exciting? And of course, if you'd like to join the Rebel Underground, every time I say it, it upsets me I didn't come up with it. If you'd like to join the Rebel Underground, text the word Rebel Broker to 44222. That's text the word Rebel Broker to 44222. Reply to the prompt that'll let you know you've contacted the right thing, and give it your email address, and you will be a member of the Rebel Underground, and you'll get all kinds of insights and free stuff for doing that. So jump right in. The water's fine. We're a little bit more. We're gonna talk about probably some real estate specific stuff here, but a lot of this is bigger picture stuff, like economic stuff, the kinds of things that slap a real estate market around, because it slaps everything around. And it's important to understand when these kinds of moments are coming. I don't think anyone is anticipating wine and roses for the next couple of years. It seems like a lot of folks are anticipating not great stuff happening. But in some areas, people seem to think that they are insulated from these things. Not so sure that's true. I'm sure a lot of people, in fact, I know for a fact, an awful lot of people thought that was true of Silicon Valley before the downturn in 2006, 2007. And that didn't turn out quite as hoped. So let's go ahead and run through these. There's several interesting articles here, all that sort of beat this around from a different angle, but kind of all leave us facing the same potential future, which is concerning, because when you've got that many things all sort of pointing to the same thing, that's creepy. It tends to give it a little bit more credence. So the first article we're going to discuss comes from MarketWatch, and the headline is "The IMF Cuts Growth Forecast for the U.S. and Its Neighbors." Now, Now, it doesn't cut it. It doesn't mean negative growth, right? But it is a reduction in growth. And this is a perception thing, right? The article starts by saying new weakness in North America, coming on top of concerns about China and Europe, is adding to a sense of disquiet about the global economic outlook, the International Monetary Fund said Tuesday. Now, you got to remember, these guys are very careful about how they select their words. This is not one of those moments where they bring an intern in and say, hey, you know what? Why don't you write up our global economic outlook? So there's a lot of very careful phrasing because they realize that the International Monetary Fund is in charge of big, big stuff. And every time they say anything about anything, they're sending a signal to folks out in the financial markets. So it's important for them to be careful. To use a word like disquiet about the global economic outlook, that is not a foundation to build confidence on. And for them to say that, you have to figure that's the softest word they could come up with to describe what they see as coming. So let's what did they see? Now, in its latest report on the global economic outlook, the IMF trimmed its forecast for U.S. growth this year by over 0.5%, so 0.6%. And that's for just this year, and next year it's trimmed by 0.3%. Now, there was already a lower expectation for next year, and so they've trimmed it even further. They noted that the Federal Reserve has so far judged a second interest rate increase as too risky, and that's something else we could talk about. There's a fourth article that we could go dig up. That's one I came across a few weeks ago, talking about the Fed and how dramatically that's been screwed up. And this also, if you did not listen to the YouTube video that I embedded in the show notes, now I didn't play it because I didn't think I had the rights to play it, and I still don't think I have the rights to play it, but I would love for you to listen to it because the frustration of that guy in talking about, international monetary funds, all this stuff, that just how all these money manager folks think they're helping, and he just begs them to stop helping. I think that's what's going on. You don't even need to imagine some crazy cabal of conspirators that are trying to do nefarious things with international funds or monies or the dollar or anything else. I think by and large, all of these people absolutely believe they are doing what is best, and they are making it, are there those folks who are strictly interested in their own personal profit? Absolutely. But there are also folks who are sincerely interested in creating a robust marketplace for people to succeed? Yeah, I think they are. But I think this is just a perfect example of once you start introducing folks who mean well, you end up with a lot of really bad stuff. There tends to be an aversion towards letting bad things happen. And when you let a lot of little bad things not happen, that doesn't just go away. The bad things don't just go away. They accumulate. So when a bad thing does happen, it tends to be bigger and worse than if you had struggled through several small things over the course of, say, 5 to 10 years versus having built up all of this negative stuff because of the actions you took to prevent the little bad things, now having to come home and settle in on everybody's lives when they are big and ugly and will hit you super hard and make things difficult for a long time. We can go at some of the other things they point out. Growth in Canada was trimmed by 0.2% for most of this year and next. Growth in Mexico was cut by 0.4% in 2016 due to weak export performance, and by 0.3% next year. For the global economy, the International Monetary Fund made no changes to its forecast of 3.1 growth this year. So what they're saying is, internationally, across the globe, they made no changes to its forecast of 3.1%, but it was down from the 3.2 number that they put out for 2015. So they're not modifying what they think the globe will do, which is interesting because what they're saying is other players will have growth higher than us. In other words, we're the ones that are sort of causing the problem here. And it'll get made up by other players in the international market. That's kind of a creepy thing, too. Let's see. Two factors are at play. Several countries like Brazil and Russia are coming out of deep recessions, and other fast-growing countries carry more weight in the world economy, according to the IMF. Growth in emerging market and developing economies is expected to strengthen in 2016. But unfortunately, all that stuff doesn't help us. If we stay focused on our economy, they're expecting us to not grow as much as expected. So for 2015, they expected 2.6%. The forecast for 2016 is 1.6%, and the forecast for 2017 is 2.2%. You're going to hear it here first. I'm willing to bet that number will be higher than what they really get, or at some point between now and before 2017, they may revise that downward further. So there's that. There's that sort of metric or that particular data point that we can sort of hang our hat on in terms of what the IMF thinks is going to happen. Next, this is an article coming to us from Housing Wire relating to CoreLogic. CoreLogic expects home prices to peak in 2017. Now, of course, a peak implies leading up to a high point followed relatively quickly by a downturn. Prices slightly below 2006 levels. According to this article, home prices increased in August both monthly and annually, according to the Home Price Index and HPI forecast released by CoreLogic, a global property information and analytics and data-enabled solutions provider. Home prices, including distressed sales, increased 6.2% annually in August and 1.1% from July. Home prices are now just 6% below the nominal peak reached in April of 2006. That's according to CoreLogic chief economist Frank Nothaft. Nothaft? Nothaft. Okay. With prices forecasted to increase by 5% over the next year, prices will be back to their peak level in 2017. Let's see here. The HPI forecast shows that home prices will increase 5.3% annually by August of 2017 and increase 0.4% from August to September. The CoreLogic forecast is a projection of home prices using the CoreLogic HPI and other economic variables. Let's see here. They go on to say here that housing values continue to rise briskly on stronger fundamental and investor-fueled demand, as well as a lack of adequate supply. Now, this article is clear. The way they're phrasing this is clearly not it's going to reach a peak. I'm going to claim that that's actually what's going to happen, that we will hit a peak. But what they're saying is simply we're going to meet the previous peak that existed in 2006. Mathematically and everything, that makes sense. But what they're putting in here is something I think is worth being worried about. They mention investor fueled demand, stronger fundamentals. And I'm not in the stronger fundamentals game. I'm not sure that that's true. Given the news we got yesterday about prices in Manhattan, for instance, a major area where we've seen a dramatic drop in the number of sales and an increase in inventory, which, given those two things, is an oddity, which spells to me that the next thing that needs to shift is price. I think that we have to remember how we got to the prices we were seeing in 2006. They were ridiculously overpriced based on an artificial manipulation of the number of buyers in the marketplace. Now what we have is ridiculously high prices as a result of extremely low inventory. And a ridiculously low level of construction. And we can have discussions about why that is, but that's what's happening. My feeling is that in this equation, something has to give, and hitting a number like that 2006 number does not fill me with confidence. It fills me with the same kind of concern that I had when we hit those crazy prices before. And the thing that gives is the people's willingness to pay the prices. There needs to be... There's only so much you can force on folks, and that includes everything from rent to home prices. And I don't think that hitting this peak is the milestone they're putting out. I don't think meeting this previous peak is, hey, wow, here we are. Here's a milestone. We've hit our previous peak and onward and upward. I really don't think that's for me, that's not the takeaway here. Maybe I'm just the guy who absolutely wants to see the storm cloud instead of the happy cloud. But I honestly don't think this is something that we need to be excited about or happy about. Now, I've got one more article on this subject, and while it is from Zero Hedge, it's not a Zero Hedge story. It's really a Bank of America story. And I want to share it with you because I think it dovetails nicely with things we've talked about, whether we want to talk about Manhattan and the interesting recent decline in what's going on in real estate there, or we want to talk about some of the other interesting migrations of folks away from more expensive areas, or put it in context of growth going down in the United States. Reduced growth does not spell more jobs. It doesn't spell higher wages for the folks who have jobs now. That's not what any of that spells. So let's take a look at this. We're going to take a quick break right now, but when we come back, we'll talk about what B of A is talking about and the words. And we talked about how carefully these big institutions choose their words. This one will blow your mind, so don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Hello, everyone, and welcome back. We're kind of taking a quick pulse here, I guess. There have been a few interesting news items that have come out over the last few days. The IMF cutting its forecast for our economy. CoreLogic talking about how we're about to reach a dubious milestone in terms of hitting what prices were at their peak in 2006. And if we all remember how we got there, it wasn't good things that got us to that number. And I don't think it's good things that got us to, are getting us there again this time. It's not on solid fundamentals that we're getting to this. That's why I think I have a problem with it. It's about very bizarre low inventory situations that are really making these prices crazy. But anyway, the next thing that I think is, again, sort of while we're all often very focused on real estate and what happens specifically within real estate, this is another story that really speaks to us relating to the broader economy and how impacted a real estate that we deal with would be by something like this. So let's go ahead and hit it. The headline here is B of A says it has found evidence of an imminent recession. And that's in quotes. So let's kind of go through here and see what they're saying. Now they do a little backpedaling here, but really kind of up front. As Bank of America's Savita Subramanian writes in an overnight note titled, "Is it about time for a recession?" While the bank's economists do not officially predict a recession in the coming year, instead forecasting low and steady growth in the U.S., the strategist admits that over 7 years and more than 270% into this bull market, one wonders how much longer this cycle can last. While B of A writes that it has not yet found a model that accurately forecasts recessions, and even if, quote, even if we did, not all recessions result in bear markets. In examining some of the bank's favorite indicators' recent trends, it has, quote, found evidence for an imminent recession, unquote. It adds that while the range of signals is wide, in aggregate they do suggest that if data were to continue to weaken in line with the recent pace, history would point to a recession in the second half of 2017. That's kind of interesting because that also coincides with when we're supposed to hit the 2006 high of home prices. I don't know. That's kind of fortuitous. Interesting how those two things kind of work out. Let's see. Here's the explanation that B of A used to determine that a recession was imminent. What if current trends persist? We chose 5 macro indicators and determined what levels tended to coincide with historical recessions and bear markets. While we are cognizant that trends change and that relying on the recent trend can often give you false signals when trends reverse, we also think that there is some value in considering what might happen if the current trends were to persist. In this exercise, we extrapolated the trends over the last few years in an attempt to estimate when the recessionary thresholds will be reached. In this scenario, the range of potential recession start dates implied by these models was as early as July 2016 and as far off as April 2019, with an average start date of October of 2017. So that's kind of interesting. And, you know, if there is one thing that I would not say about the last bunch of years, the last decade, is aside from dramatic increases in home prices, I wouldn't say that the trends that we've seen in terms of broader economic trends have been horribly volatile. Things have generally not trended horribly well. We've seen some mild changes here and there, but I think that questioning their conclusion based on a volatility in trends argument carries very little water. I mean, if we were experiencing a lot of volatility over the last year, I'd be all over that. Now, has there been stock market weirdness? Yeah, absolutely. But I'm not thinking that I'm not even thinking we've had the level of volatility there that you'd use as an excuse to suggest that the indicators that they're looking at suggest a recession. So what do we do with that? I think mentally you prepare for the possibility that that is what is going to happen. And I'll tell you what, it's things like that that have me thinking, it's probably not unwise to, within the next 6 months or so, execute my plan of selling my place, and then start looking for a new deal that will improve my cash flow. And I don't want that to be so. And let me make it clear: I'm not going into a contraction mode. I had one person email me and say, "Oh, what are you going to do? You're going to start just really accumulating cash." And no, I'm not. I prefer cash to be at work for me. So my idea is to turn one property that I'm currently in into potentially two properties, where I buy one and I live in it, and I buy another one and I rent it. Both of them smaller. I like the idea of having something that I can rent that will appeal to the largest number of people. And while the home I'm in has got plenty of bedrooms, in terms of just ease of upkeep and being the most attractive in terms of ease of commute and all these other types of things, to insulate myself as much as possible in terms of the desirability for folks who are living real lives, I kind of like that idea a little bit better. So that's kind of the goal. So it's not a contraction on my part, as some folks who contacted me asked. They didn't use the same words every time, but it kind of implied that I was withdrawing a little bit. Not really what's gonna happen. I actually consider it a move more into the marketplace to be there to provide what I think is going to be a resource folks are going to continue to need for the long term, and that's housing. Let's see. There was one other paragraph here, and I'm trying to find that I thought was kind of interesting. B of A has another warning to those looking to sell upon reading the report. Quote, "The end of bull markets have been painful to miss." It writes that even if we are in the later stages of this bull market, and despite concerns about a near-term market correction, B of A cautions long-term oriented investors against going too far in reducing their equity exposure. History would suggest that unless you can pinpoint the peak of the market to within a 12-month time frame, you're typically better off staying invested. So that's, it is what it is, I guess. Let's see. And then finally, they say one should recall that both the current business cycle as well as the 270% bull market are entirely creations of central bank liquid generosity, which is why it is safe to say that as of this moment, the world finds itself in uncharted territory. It also explains why, if Bank America is right and the recession may be imminent, then there may have been substantial hints by both central and commercial banks, not to mention economists, that the next step by the Fed may be to buy equities outright. In that case, the outcome may be a pinnacle in paradoxes, a crashing global economy as stocks rise to new all-time highs. So that's all creepy stuff. The situation does not get better. It gets potentially more convoluted, particularly when folks start bringing up the idea of the Fed buying equities. That would be a bad thing. The Fed should not be investing in equities, and that just completely, I think, turns the model around to one where the assuming that kind of a risk, I don't think is good. I just don't think that's the position of the Fed. That's not the responsibility of the Fed. All right, folks. Granted, not the cheeriest of news today. we are starting to head into the season where everybody starts offering their initial forecasts for 2017. So maybe we'll start with a couple of those. The National Association of Realtors has come out with theirs. There was one other that came out with one that I came across yesterday. I may be remembering the CoreLogic one about prices to peak in 2017. But there are a few out there. National Association, the Realtors, that's the one. So we'll probably talk a little bit about that to see what they expect. And of course, we can always count on them to usually take the shiniest approach. So we'll do that, and like we did last year, we'll cover all the other pundits and see what they have to say, and see where we're most likely to put our faith in terms of what folks are expecting for 2017. Thank you very much for spending your valuable time with me Monday through Friday. I consider it to be a great gift, and I hope that I am able to return the favor with some good information for you, or at least a few things that you can think about relating to your future in real estate, or maybe just your place in the world in general in terms of what's going on with the economy and real estate. Thanks again for listening, everybody. I'll talk to y'all next time.